Hello, hello. Hey, Clinton, good to see you.
Hey man, yeah, good to be here.
How you doing?
Good. It's been a busy few weeks. So,
How good? What you got on the go right now?
actually, it's kind of funny, but I've had a lot of older people wanting to set up some kind of like life insurance or I have a funeral concierge package that I help people with, but basically look at some estate planning options. So,
Oh, nice.
yeah, and then yeah, just working with a couple new agents. So it's been a busy couple weeks.
Well, that's good. Busy's good, right?
Hmm.
Mhm. Hello, Liam. Good to see you. Matt, Victoria, Nathaniel. Nice to see you guys. Thanks for joining. We just got more people coming in. Going to give it a few more minutes before we
and
get started.
in the driveway. Well,
All right. Got a nice turnout tonight. Yes, I appreciate everybody accommodating my late start. I got two young kids, so there's always the risk that they just don't refuse to go down. So, my wife, she's working this evening, so I had to get a rush on putting my eldest daughter down. She doesn't like to go down that easily, likes to wrestle before bed. Luckily, she went down fine. All right. If you guys are comfortable, I'd love to see some faces. You can turn your cameras on. Uh, like to see who we got here. Hey, Victoria,
You there?
how's it going? Sahej, did I pronounce that right?
Yes, that's right. That's right. How are you?
I'm doing well. Doing well. Where are you calling from?
Nice. Brampton, Ontario.
Oh, nice. Not too far from me then. I'm in Guelph.
Oh, okay,
Hmm.
cool, cool.
Very cool. What do you do, Sahej?
I'm a real estate lawyer.
Sorry,
Um,
say that again.
a real estate lawyer.
A real estate. Okay.
So I work at I'm working at a firm, but it's kind of like it's almost like an in-house firm in a larger company
Mm-hmm.
that provides like financial services, and they do a lot of real estate and financial like mortgage stuff, real estate stuff. I think they're even doing some development at some point too. So it's pretty interesting. Yeah. I thought it'd just be a really good match to kind of like, um see what you
Mm-hmm.
guys are about and what you do. And
Yeah,
yeah.
well, I think most of the information we're going to cover today, you probably have an understanding of. The presentation is going to be coming from our perspective as developers, which I'll get into, but it's interesting the state in which the Ontario real estate market is in right now, and the opportunities that can come about with recent changes, and that's what we're going to cover today. Hopefully you'll learn something new or get something out of it. And worst case, we're just
Yeah,
confirming what you already know.
yeah. I'm sure I'll learn something new. So thanks. It'll be awesome.
Yeah.
See.
All right. Well, I'm gonna pull up my slideshow here, and we'll get things going. All right. While I do this, if you guys could just make sure you mute yourself during the presentation. We'll have a Q&A session at the end where you can ask some questions and we can have a discussion about what was presented. All right, let me share my screen. Now, which screen can you guys see? Do you guys see the main presentation or the notes?
your notes.
You see my notes. All
I
right,
see both.
both. Well, that's
Yeah, I see
Yeah,
a why investing in development is Ontario's smart move, and then a disclaimer side note.
all
it's your
right.
presenter's view.
All right, how about that?
There you go.
Perfect, thank you. All right, so the topic I'm going to be discussing today is why investing in development in Ontario is the smart move, not just for investors, but for Ontario in general. Um, and before I get into these things, just a quick disclaimer. So the information contained in this webinar is intended for general information and educational purposes only. It's not meant to be a substitute for professional real estate advice. And while we've made every effort to make sure that the information here is accurate and reliable, we don't make any warranties as to the completeness or correctness of the information. Any reliance on this information is strictly at your own risk, and the market trends, laws, and regulations can vary depending on the local area that you're subject to over time. So that's my quick spiel. A bit about myself. So my name is Samuel Hirschhorn. I'm the principal and director of business operations and development at Biosis Real Estate Development. That's my development firm. I also run an architecture firm because I am a licensed architect. I've been in the industry for over 10 years. That architecture firm is called Biosis Designs. So we kind of operate under the one umbrella. And the idea is that our development branch goes out, finds the deals, analyzes them, puts the projects together. Then the architectural firm comes in and does all the design work, project management work, and oversees the construction through to execution. That's when the development company comes back in and manages the assets. So as I mentioned, I was the co-founder of these two companies. I do have partners on both of them who won't be presenting with me today, but they are valuable members of our team, and a lot of what they do has been incorporated into this presentation. Personally, I've designed and built projects of a wide range of values, but my largest one to date has been a little over 50 million. That one is a 180 unit assisted living facility. We're also working on a few other mid-rise scale projects, which I will show you closer towards the end. But my career has taken me from doing industrial projects, multifamily, residential, custom homes, you name it. I've even done an expansion to a Brampton brick manufacturing plant. So a wide range of projects under my belt has given me kind of a behind the scenes look at real estate development and given me a strong understanding of how to get these projects done. Currently, our development arm, we've got about 790 units of residential construction in the company pipeline. These are various projects. The largest one, that one's has to go through an official plan amendment, zoning bylaw amendment, and then site plan for about 600 units. So that one's a long-term project. We have included in here to make us look really good. We've got a few other projects that are shorter term, about 190 units that are getting through pre-planning and into the design and construction phases. Lastly, I am an investor myself. I do have a portfolio of rentals that I manage. I'm also an entrepreneur, having started several companies, and I do enjoy public speaking. So that's a little bit about myself. The purpose of this presentation is to dispel the myth that Ontario is not a great place to invest in real estate. I'm a part of a lot of investor groups and organizations, and I'm constantly hearing about people who say that Ontario, oh, I can't invest here, it's too expensive. I'd rather go to the United States or another province. I'm here to say that's fine for you, but we like this province. In this presentation, I'm going to outline why. I'm also going to illustrate the huge opportunity that's available to invest in new construction in Ontario, and specifically new construction because that's our niche. That's what we do best. And then we're going to discuss the challenges that exist and how to navigate them. So what this presentation will not do, we're not going to argue that Ontario is a better place to invest than other provinces or the US. There are opportunities everywhere. We've got a growth mindset. And really, as an investor, it's important to find the right fit for your capital. That can be what you're most comfortable with, the asset class, the location, you name it. You got to find your niche and what is going to work best for you. And there we go. This presentation also won't act as investing advice and shouldn't be relied upon as legal, financial, or professional advice. This is strictly our opinion and our experience. So you can take it or leave it. We're just kind of putting this information out there for you. So to start, let's take a look at Ontario's real estate market. We've all been paying attention to the news. We know every single day on the CBC, there's a new segment about how unaffordable real estate is in Canada and Ontario specifically, and in Toronto even more specifically. But how has this happened, and what was the trigger? Where are we, and where did we come from on this sharp rise? So this graph depicts the benchmark price performance over the last 20 years. So the benchmark price, it's not the same as the average selling prices because the average prices can be pulled and skewed. This is more based on similar properties and recently sold properties that have been compiled into a long-term depiction here. So what you'll see is you've got the single family, one-story single family in orange here, two-story in blue, and the composite index here. And we're going to see here, this is the 2008 crash. So leading up to 2008, I'm sure the US graph is very different. I'm sure it has a higher peak here, and then a much larger trough. Canada was largely insulated from that, not completely. I mean, when the US catches a cold, Canada gets very sick. But we had a minor dip, and then from there, steady growth, steady and consistent growth for the next almost 10 years. And roughly around 2016, we had a steep run up in pricing, followed by a little bit of a downturn, but then pricing started to go up again at a more steady pace. This is where COVID started to take effect here. We saw that dip when we had that lockdown, and no one knew what was happening. Anyone who was trying to sell a house was probably freaking out and wondering what the future is going to hold. But not too many people predicted that there would be such a huge uptick and a huge run up in the prices. Hindsight tells us that when the government starts injecting capital so that you stay home and don't go to work, and that amount of money being put into the system is obviously going to cause inflation. And as we know, real estate is a hedge against inflation, mainly because as inflation goes up, the price of real estate goes up, and that's what we're encountering here. As we reach the peak, this would be around 2022, and then we had the interest rate hikes suddenly create a sharp drop in the market. We had a recovery around mid 2023, and then more interest rate hikes cause it to go back down. And as we all know, we're now at interest rate cuts. So I fully expect at the end of this tail for prices to start increasing again. So we're here. What I want to point out is while these major peaks and valleys seem intimidating, these are all your low-rise townhouse single-family home. Excuse me. The blue line here, that's apartments. And what you'll notice is that it's actually been relatively stable by comparison. The peaks aren't nearly as high. The valleys aren't nearly as low. So apartments have been a pretty stable investment over the course of this market fluctuation. Now let's look at the population growth over the last 20 years. We've in Ontario have experienced a steady growth of at least 1.8% annually. The accelerated growth has really started and peaked in 2020. Although this graph taken, I believe, doesn't account for the recent immigration numbers. But you can see that the total growth here, the total population increase, has been rising quite steadily and quite dramatically over the last 20 years, to the point where we've gone from to early 2000s, well below 12, 13 million. We've now added about 3 million people since then. And it gets really interesting. Oh, here's COVID. Yeah. When we compare that to our GDP, so the GDP in Ontario contributes to about 40% of the national GDP, so the national economic output. At 40%, it's a pretty significant number. In fact, it's the highest in all of Canada. Ontario's per capita GDP is about 10 to 15% higher than the national average. And that growth rate between 2000 and 2023 has been consistently around 2.5%. In 2009, this is our financial crash, we had a dip due to that crisis. But you can see ever since then, it's been going up until COVID locked everything down. And now we're in a bit of a recovery. So overall growth to economic output and population, we can see here, there's a wide gap back in early 2000. That same gap has been maintained right up until 2015. And from that point on, we had a shrinking between the real estate prices and the economic growth and the total population growth. So this is where we're at today. It's a much, much narrower margin. And it's that narrowing of that gap where everyone's starting to feel the squeeze. It's becoming very difficult to afford to live in a lot of these places because the cost of living has just increased so much and the economic output has not kept up pace. In addition, the population growth has been steadily going up as well. So more competition, less opportunity, and higher expenses is putting everyone in a bit of a squeeze. So the next piece of the equation is the new construction of housing. Over that same time frame, the main housing products being brought to market were single detached homes and multiplexes, duplexes, triplexes. So here, this orange bar, that's your single detached. The dark green bar, those are your multiplexes. And then this blue bar is the overall. So if we look at the orange bar trajectory since early 2000s, it has been going down. And there were some times where it did bump up, but overall, the trend is going down. Now, there's a reason for this. Another point that you'll see is this light green line, that's apartments. Apartments have been trending up. And to the point where it's actually apartment starts and completed constructions has overtaken single family detached housing. Multiplexes have been steady, and I believe that the reason for this is twofold. First, land value and construction costs. Land values have been going up, and construction costs have been going up, meaning to build these single detached homes, the margins are getting squeezed for developers. It's getting harder and harder to make numbers work when you're dealing with lower density. So we're building higher density. As developers, we're looking for, we're putting more units on a single lot. We're making smaller homes. We're doing smaller backyards, whatever we can to offset that rising cost of land and that rising cost of construction. And here's a graph that kind of depicts the CPI, or the construction price index. And you can see this yellow line, that's your residential construction price index, versus the blue line, which covers more commercial and multifamily. The cost of residential has gone up quite significantly, especially in the last 4 or 5 years. So this graph here, this is overlaying the annual change in population versus the housing completions in Ontario. So we can see the housing completions are kind of all over the place. We had a serious drop in the 90s, followed by a boom early 2000s, and then dropped back down to mid 2000s. and now it's kind of bumping along. We're not quite at our all-time highs, but we are improving, or at least in 2022 we were improving before interest rate hikes killed pretty much most of the new construction starts. On the other hand, our population has been increasing steadily and quite consistently and dramatically. The result, more people looking for places to live, fewer places to live coming on the market. It's putting a strain on the market in general. So when is a bubble not a bubble? Experts and economists have been calling Canada's and specifically Ontario's real estate market a bubble for decades. Yet we keep waiting for this bubble to burst. Who would have thought, coming out of 2008, that Canada would have had such a, meh kind of reaction? There really wasn't much of a price drop. Same thing happened in COVID. We were all kind of flabbergasted. Wow, the bubble didn't burst then, and now it's even worse than ever. We have all sorts of news outlets calling this Canada's bubble, affordability crisis. When is the air starting to seep out of Canada's property market? What's really going on here? Well, the standard definition of a housing bubble that most news outlets seem to agree on is a housing bubble is a run-up in prices fueled by demand, speculation, and exuberant spending. A housing bubble happens when prices of home rises quickly at an unsustainable rate. Housing bubbles occur when prices are disconnected from fundamentals and the demand is being pushed by housing of a speculative nature. That doesn't tell me very much. I don't think it would tell you very much. It just basically says housing is a bubble when the prices seem to be too high. Well, what we actually understand a bubble to be is that a housing bubble is driven by factors outside of the norm, such as manipulated demand, speculation, unusually high levels of investment, excess liquidity, a deregulated real estate financial market, or extreme forms of mortgage-based derivative products, i.e. fraud. And this is really what happened in 2008. The crash was not from people who are over leveraging and the run up in pricing just made things unaffordable. That was part of it. The crash in 2008 occurred because of a mix of predatory loans, unregulated lending practices, the securitization of risky loans, i.e. giving people who really shouldn't be taking out loans or loans of that size, mortgages, and then bundling those mortgages and selling them to the banks. And it was those banks who bought up all these AAA standard bonds, thinking that they were getting a good investment, and then they were left holding the bag when the defaults started to happen. So basically, the rug was pulled out and the house of cards collapsed. Our banking system here is actually extremely solid, and the regulations have been put in place to prevent that from happening. So let's look at the first criteria here, manipulated demand. I don't believe we have manipulated demand unless you count, the federal government's immigration policies as being manipulated demand. The fact is here, people are coming in to the country to the tune of almost 1 million. I think it was 1.2 million people last year. That's a lot of people coming in, and it takes time to build new housing to accommodate that. So demand is not being manipulated, it's there. Next, look at speculation. Well, speculation implies that you're kind of rolling the dice and banking on the future fitting your model. I don't see that as being speculation here because, again, we just have such high demand and people are settling in areas that generally are already desirable and attractive places to live. In fact, those attractive places to live are so attractive, you have people who will, have 10 people trying to rent out a single basement apartment. There's an article in the news, I think it was 6 months ago, how they found, cots set up in the basement, and a family of immigrants were trying to support their family in this tiny little basement apartment against code and against regulations. So the speculation, I don't think is there. Now, of course, there's always speculation in any investment industry, but it's not to the point where we're facing what might be considered a bubble. Unusually high levels of investment, well, we're actually having the opposite problem. Investors are taking their money elsewhere. The increase to the capital gains inclusion rate, I'm sure, accelerated that. So we're not seeing a massive amount of capital flooding into the markets. Another reason is that the government imposed a foreign buyers tax and restricted the amount of homes that any foreigners or people who weren't Canadian citizens could actually purchase. So excess liquidity, yeah, you could argue that there was a lot of excess liquidity injected into the market due to COVID. Now, because of the interest rate hikes, that has acted to take a lot of that liquidity out of the market. And lastly, a deregulated real estate industry or fraud, well, there's no signs of systemic fraud in the market right now. So, as I may have mentioned, Ontario's run-up of housing prices fueled by three factors: record immigration and population growth means high demand, high economic growth and access to debt, and then lack of supply, specifically new construction not keeping up with that demand. So these factors are quote unquote normal. So in my opinion, it doesn't equate to a bubble. Here's an example. So Ontario's population grew by 517,000 people in 2023. That's the size of the city of Mississauga. Could you imagine we added a full city the size of Mississauga to our population in 1 year? How do we even build that? We can't. We aren't. Ontario's GDP, 40% of all Canada's GDP. So we are the economic center of Canada. And we need 1.5 million new homes over the next 10 years in order to keep up with the current rate of demand. So what would it actually take for Ontario's market to experience a correction? Based on our analysis, Ontario would have to lose 1.5 to 2 million people, or 10 to 15% of its population, before it would experience an oversupply in the market. Now, obviously, that number can be changed if you are overbuilding and people are leaving, or if you're underbuilding and too many people are coming. Obviously this is a general number, but to give you a sense of what it would take, if you could snap your fingers and take 2 million people out of Ontario, then we'd start to see a bit of a correction. Another point here about Ontario being the heart of Canada. So we have the largest economy in Canada, and it's a diverse economy. We've got manufacturing, we've got technology, service-based industry, finance, lots of natural resources. We're highly diversified. I'll use Alberta as an example. They are less diversified. For most of history, they've been reliant on oil and natural resources. I think that's changing. I think they are diversifying their economy now, but they were heavily reliant upon oil, and whenever the price of oil would tank, it would experience a drop off in their population, and the housing market would reflect it. So there was a lot of volatility due to that. Ontario does not have that problem because there is such a diverse industry and economic engine in this province. We also house 40% of Canada's population, specifically along the 401 corridor. We've got, I think, 12 million people that in that strip of Ontario, representing almost 30% of all of Canada. It's also the seat of power. We have our nation's capital. We have Toronto. We have the GTA. And we also have stable climate. Ontario is centrally located, access to the USA and key trade routes. We have world-class cities, tourism, and attraction. So Ontario is a very desirable place for people to come and live. But there are still issues, right? Housing prices, obviously not affordable, huge shortage of rental housing available. Laws for rentals, they heavily favor tenants over landlords. So for investors, that's particularly frustrating. Um, and the landlord and tenant board is seriously backed up. It does have its problems, aggravated by COVID, certainly, but also, deep-rooted systemic problems that do make it very challenging to be a landlord. And as a landlord here, I can say it is a challenge. Thankfully, I haven't had any serious issues. I did have to file for eviction on one of my properties, but it only took about 3 months for me to get a hearing, not the 18 months horror stories that I've heard. Our infrastructure is quite strained because of the massive population growth, and new construction just is not keeping up with demand, as I mentioned before. However, as Ryan Holiday says, the obstacle in the path becomes the path. Never forget, within every obstacle, there's an opportunity to improve our condition. So we believe that although it's a challenge, that challenge presents opportunity. That said, what is actually being done about the housing crisis? So recent legislative changes brought by the Ontario government include Bill 23, More Homes Built Faster Act. There's also Bill 108, More Homes, More Choice. Bill 109, More Homes for Everyone. And Bill 197, COVID-19 Economic Recovery Act. So these are the four main bills that have passed within the last 5 years. And I'm going to be talking about the parts of those bills that specifically benefit real estate developers and investors. First of all, those bills have created an accelerated approval process. If you're at all familiar with the approval process in Ontario, in order to get anything built, you need to go through site plan approval. You make sure that your zoning is your design is meeting the zoning bylaws, and then you have to get your building permits. And that process has been in the past extremely arduous, very long, difficult to navigate, complex. And the Ontario government has enacted these changes to expedite this. They are really pushing to try and shorten up these timelines, make things easier for people to build housing. So this includes eliminating site plan control for anything 10 units and under. That means you don't have to spend the year submitting studies, going back and forth with planning officials, making sure that your property adheres to every little detail of the zoning bylaw. I mean, you still have to adhere to the zoning bylaw, but you don't have to go through this long process of a site plan review. So 10 units and under, you can build as of right where zoning allows. 3 units are permitted as of right in any residential zone. So that includes single family housing areas. And this is a bit of a game changer because anyone who has a single family home and wants to split it into a duplex or a triplex can just go straight and submit a building permit and get it done. These bills have also restricted third-party appeals. This has been a big one in the past, especially for developers. NIMBYism, if you've ever heard of that, so that's not in my backyard. So locals and local activist groups have been a thorn in the side of developers for decades. These changes now restrict who can actually file appeals, who can hold up development processes, so that they don't have as much power. It hasn't completely eliminated their power, but they don't have as much especially when things are being built as of right. Reduced public consultation requirements kind of feeds into that. So this is typically done during site plan control or a zoning bylaw, where you have to post that you're making a change to the site, and then you have to engage with the public and receive their comments and try and make them comfortable with the development. So this process has been reduced in most projects now, especially when it comes to building rental apartments. It's almost been eliminated entirely. And lastly, limits to conservation authority powers. This one, I'm not entirely sure how I feel about it. I know that conservation authorities do delay the process. There's a lot of environmental testing goes into developing a site. I feel like it's important to preserve and protect our natural environmental ecosystems. At the same time, there's a lot of bureaucracy that has been eliminated, and things that are kind of a no-brainer. Like if your site is not in a wellhead protection area, if your site isn't close to any national parks or highly sensitive ecology, you shouldn't be forced to go through the thousands of dollars of testings and studies and reports just to say what everyone already knows. So thankfully, these changes have reduced the amount of power that the conservation authorities have to insist that you get these studies done, unless they've identified something that would trigger it. Getting into the weeds here of the development process, but let's carry on. So what sort of incentives are also coming out of these legislative changes? There are development chart discounts and deferrals for rental apartments. Now, this is going to vary between municipalities, but when the Bill 23 first came out, they have a phased discount between 5, 10, 15, and 20% discounts, depending on your level of affordability that you're introducing to your projects. And development charges are a big cost. They can be as high as $32,000 per unit. It depends on the municipality, of course, but that's a huge chunk that's just getting added onto the project so that the local municipality can take their taxes, essentially. By eliminating a lot of that, a lot of developers are just giving that right back to their future tenants. They're able to reduce the cost of housing just by eliminating the development charges. Parkland dedication fees are also another tax that is being waived or reduced. For those of you unfamiliar, basically you have to pay a certain amount of tax for your property, or you have to allocate a certain percentage of your property as parkland. Often it's not feasible to give a piece of your property up for parkland. It'd be too small, so they make you pay instead. Increased density and decreased parking requirements for rentals is a big one. A lot of municipalities are allowing for more density in residential areas, and they're removing parking requirements or setting maximum parking rates. This can be a challenge for developers because most tenants tend to drive, but if you're in transit-oriented neighborhoods, it's fantastic because parking is a deal killer. They've also allowed for fast tracking rental housing applications, refunds for delayed decisions. So if you're going through site plan approval and the government set a 60-day timeline. So if after 60 days, the planners have not either approved your proposal or come back to you with comments, they go over that 60 days, they actually have to refund your fees. So they're holding the planning departments to account, saying you need to process things faster. There are some tax and and other exemptions, including some property tax reductions. And lastly, new construction is not bound by rent control. It's exempt. So when you build a new apartment unit, you can immediately set it to the max price or the market rate. And if you turn over and your apartment is under 5 years, you can also set these rental rates to the market rate. Here's some examples of the results of these provincial changes. So Toronto recently made zoning bylaw changes allowing up to 6 stories and 60 units on residential land as of right along major streets. So I'll explain that. Along a major street, let's use Yonge Street as an example, within the city of Toronto boundaries, if you've got a single family house and it's abutting Yonge Street and it's on an oversized lot, you could fit as many units as you want within 6 stories, up to 60 units on that lot. Now, there are other zoning bylaw provisions that are going to restrict how many you can do, but you can do that as of right. And I've heard Olivia Chow say she's trying to make it so that you don't have to go through site plan approval to do that. Hasn't happened yet. I'm keeping my fingers crossed it does, because that would be a game changer. Going through site plan approval in Toronto is very difficult. Toronto's also removed all parking requirements. They want to make everyone take public transit if you can. So developments no longer need to factor in parking. You don't need underground parking. You need minimal surface parking, maybe a few visitor spots. That's about it. Ottawa's making similar changes. They're allowing up to 6 stories on major and minor corridors. No minimum parking requirements around transit hubs, corridors, or downtown zones. And they've also allowed you to build up to 4 units on any residentially zoned property as of right. The last item here is the Housing Accelerator Fund. I'm not going to go through each point, but the general gist is that the government is providing funding and financial support to all municipalities who meet the housing growth targets and improve development approval timelines. This Housing Accelerator Fund has also implemented some changes encouraging collaboration between government and developers, prioritizing approval of affordable housing projects, prioritizing transit projects, and is generally designed to modernize the system and help support developers and governments in building more housing. The next advantage, so this most people have probably heard, it's quite prevalent in the news, and it's also the financing terms that we tend to use exclusively for building apartments, and that's CMHC financing. So if you are a retail investor, or you're purchasing a house, you can get your loan insured by CMHC. And it's the same for a developer. We can get our loan insured by CMHC through the MLI Select program. And you can see the comparison here. CMHC financing has better interest rates versus conventional. It allows us to get up to a 95% loan to cost versus only 80%. So essentially, we can finance most of the project through debt. And then we can spread out those debt payments by almost 50 years versus the conventional 30 years over a term period of between 5 to 10 years. Now, the loan fees themselves are a little higher. However, those loan fees are amortized or spread out over the course of that 50-year term. So it makes building apartments much more affordable and allows us to do it with the CMHC insurance and make our numbers work and look a lot more attractive. So to sum up what the opportunity in real estate development is, we've got reduced red tape, incentives to build, we've got dropping land prices and better financing terms, meaning the the environment is ideal to build housing in Ontario. That's not to say development isn't still a challenge. The cost of concrete and steel is very high. We've got underground parking kills most projects. High-rise construction still takes years. The approvals for complex projects can be frustrating and still take a long time. We've got labor shortages to contend with in the construction industry. Thankfully, because of the interest rate hikes, most of the big developers, they canceled future projects to allocate funds to their current ones. Those projects are multi-year projects. They're coming to completion. So we've seen an actual drop in construction prices as builders and GCs and subs are running out of work. So we've been getting a lot of calls from trades asking, hey, do you guys have anything we can bid on? So we're kind of seeing a dip in the construction costs right now. But as interest rates start to go down, we expect there to be more construction and more competition for that for those trades. So the pricing is likely to recover within the next few years. There's also lots of risk involved, from poor planning and management to market shifts and changes. I won't get into that in too much detail. Rather take a look at construction costs here. So this is a study produced by the Altus Group. They do one every year looking at the range of construction costs based on location. So our projects are primarily located in the Ottawa-Gatineau area. We also have a few in the GTA. I'm just going to point out. All right, so here's what we see as working. So if you look at condominiums and apartments up to 12 stories and above, we've got very high costs to build, between 285 to 365 for 12 stories, going up to almost $500 a square foot. Wood frame residential, on the other hand, we're looking very nice, between 150 to 230 for single family residential, 3-story stacked towns, 175 to 210. Even the 6-story wood frame is landing somewhere between 220 and 285, maybe 330 in the GTA on the high end. And down here, you can see surface parking. I apologize for the quality. It's a little grainy, didn't notice that. But surface parking, very cheap. Obviously, you're not really building anything. You're laying down some asphalt. But as soon as you get into underground parking, it's almost the same cost as building above ground, right? 230 to 315 a square foot for parking garage. Yikes. And you're not collecting nearly as much rent. Even in downtown Toronto, you're probably only renting out a parking spot at between like $200 a month, maybe $300 a month. Like you're not breaking even on that by any means. So what we've been doing, we've been looking at the integration of modular construction to reduce labor and increase quality and speed. And this is a focus on wood frame. And we've been seeing that modular construction, it's kind of an emerging technology. It's not a new technology, but it's been becoming widely adopted for a number of reasons. First, it's built in a shop, in a factory, so the quality is higher. It can be manufactured while the site work is being done, and then it's shipped to site. And you can see in this picture, there's 2 people installing this wall, this shop fabricated wall with a boom truck. A typical framing crew, you're looking at 5 to 7 people minimum. So you've reduced your labor costs that way. You're also increasing the assurance of the install process, right? You're not contending with weather delays anymore because this stuff gets installed in about half the time with a lesser crew. It doesn't really matter if you lose a day or two due to weather. It can be done anytime. I'd like to show you this video, if you guys can see that. Yeah, let's see that. So these are the panels being fabricated in the shop. The panels I just showed you in that picture. They basically line up the studs according to spec, and then they've got a pneumatic. We'll just mute this. So they've got a pneumatic nailer on almost like a CNC machine, and it's tracking the studs and nailing it at intervals. It creates a much stronger panel. You can see everything's temperature controlled, moisture controlled. So it's a higher quality piece of manufacturing there. And they can produce hundreds of these panels in at a time. And there are a number of companies that are currently working on this sort of technology and just starting to come into the market. So this is one way that we see of controlling our costs and controlling our timeline to build. Okay. So what else do we see as working? So we're looking at high growth, high demand, low supply areas. That's most municipalities and major cities in Ontario. Locations that are facilitating higher density. Ottawa is a great one. They've enacted a lot of zoning bylaw changes promoting higher density. Toronto as well, but we're also seeing it in places like Guelph, Kitchener-Waterloo, Cambridge, Hamilton, and all the way along the 401 corridor, really. Access to transportation, wide range of amenities and essentials. If you're building rental apartments, your tenants need places to get their groceries, to go to the movies. They need transportation to get around. So we're looking at a hyper local level for places that meet this criteria. We're also starting to design smaller units, using more efficient layouts, and integrating storage solutions. So we all know the shrinkflation. It's applying to development as well. People don't need a whole lot of space, but the more floor area you have, the more higher your construction costs are. So part of our design exercise as architects is how do we do more with less? And that often comes down to efficiency of your design and floor plans, efficiency of your millwork and storage solutions, and then your material selections and appliance selections that all facilitate a better lifestyle using less floor space. A mix of building types is being promoted on the municipal level, as well as reflective of community growth plans and expectations. So, we mentioned the fact that they were allowing like 3 units as of right in residential low rise, but they're also allowing up to 6 stories and 60 units on major streets. So locating areas that are promoting that expansion and allowing for that added density is important, but also planning the building type that meets your specifications. So while we're focused on low to mid-rise apartments, some other smaller developers are getting a lot of success with duplexes, triplexes, fourplexes. Depending on the purchase price, depending on your level of control with your subs and your GCs, those can become quite lucrative. And then, of course, utilizing CMHC financing. And the way this works is they allocate a certain number of points, depending on how much you integrate affordable rentals versus accessibility and then energy efficiency. And we found that we've optimized it so if we have about 10% affordable units in our development, 15% accessible, which is required by code, and then you finding utilizing the energy efficiency between 25 to 40% above the National Building Code to recoup the rest of the points. That's what's giving us that 100 points and the highest level of financing available through CMHC. So I'll give you a few examples, projects that we have on the go and that we've completed. So in terms of multiplexes, to the left, this is a custom triplex that we built in Britannia Beach in the Ottawa area. This one, we bought the land at 440,000. Total project cost all in was 1.25 million, and the value upon completion is 2 mil. And that generates an annual net operating income of 75,000. So this took, so the timeline to build this sort of project is between 8 to 12 months. We had a few delays on this project because of, well, it was the guardrails, and we've got this cornice band at the top that you can see here. Sourcing that was a custom feature that we wanted to include, but that we had some trouble finding an appropriate product for that. On the right-hand side, this is a conversion. So we took a single-family home and converted it into a 5-unit apartment. This one is completed and cash flows annually over 100 grand. Again, timeline to build between 10 to 12 months. This is our latest project. So this is a 48 stacked townhouse development in Kemptville. Kemptville is located about 40 minutes outside of Ottawa. So Ottawa is full, very difficult to find housing. People have been moving to what are essentially the burbs, looking to find those commuter towns that offer access to the city, but maybe that small town lifestyle. So this one, we are able to take advantage of reduced development charges and parkland fee reductions. We also got bonus density for doing affordable units, a percentage of affordable units. We've had the approval timeline compressed. Essentially, we had to rezone the site, or we are rezoning the site, but we're also submitting for site plan approval at the same time. So we're not losing time by going through a rezoning and then a site plan approval and then permits. We're kind of doing everything stacked on top of each other. So it's going to be a lot faster to get this through and get construction started. And then there's also the reduced public consultation requirement. We're taking advantage of that. We are still going to hold a town hall with locals. We are still going to do public engagement. It's just the right thing to do. Not necessarily something they're going to hold us to do, but it's something that we want to do. Whenever we go into a community, we try and work with the locals to help them understand the project, help them understand the impact on their lives, and it just makes the development go a lot smoother. So this is an example of a mid-rise that we're working on with another partner. This one is located 500 meters from a light rail transit system and 300 meters from a bus station, 200 meters to the shopping mall, grocery store, gym, entertainment. So this is ideally placed for rentals for young working professionals, people who want to live in that 15-minute walking distance sort of a community. Here we're taking advantage of increased height and density allowed on the site. So we're getting 6 stories here. We could have gone up to 9 stories and even a little higher because of the zoning. But when we ran our numbers, we found that it was going to take longer to build. We would have had to switch to concrete or steel, meaning the construction cost would have gone up. And it would have been a lot harder to put the deal together. So we ended up sticking with 6 stories wood frame. Total project cost, we're anticipating at just under 19 mil. Value on completion at 21.5. And this will produce about 1.05 million in net operating income. And we'll be able to build this between 18 to 22 months. So to conclude, a burst bubble in Ontario, it's not likely. New construction is critical to Ontario's economy and housing supply. There's been huge legislative incentives to build. Lots of housing types are necessary, providing options to investors, builders of all sizes. And it's an ideal point in the market to buy and invest in construction. And I took this excerpt. This one made my day. Board signals reforms coming to landlord and tenant board. I don't know what that means, but I'm very excited to hear what he can come up with. So that concludes my presentation. I'll open it up to questions, Q&A right now. If you guys wanted to discuss any of the information I provided, feel free to raise your hand or put a question in the chat, and I'll answer what I can. Yeah, I know there's a lot of information to digest. Be interested to know if anyone's actually building anything right now.
Hey Sam, it's Carl Ebson here. How you doing?
Good. How are you, Carl?
Not too bad. I found that pretty interesting how your parking kills a lot of your deals. And you'll notice too, like when you look, at kind of one of the countries that probably does more multifamilies than any other country is the United States. And you'll see a lot of their garden, style multifamily. You'll notice that they're always open air parking spots, a lot of them, right?
Mm-hmm.
And I guess I never really thought of that, but I guess that's probably why, you don't see a lot of covered underground parking down in the US, right?
Mm-hmm. Yeah, they've got the land, so why spend all the money to go underground?
Yeah.
Yeah, the Greater Toronto area and Toronto specifically it doesn't have that sprawl, the same sort of sprawl that places like Houston, Dallas have. Mainly because we've got that green belt that kind of divides Toronto from the areas to the north, and it means that we've been building up, but it also means in order to do that we have to build down for the parking. And as you saw, like the cost of building underground is almost the same cost as building above ground.
Yeah, that's insanity. Like I
Yeah.
didn't realize that that's the price that people are paying to build underground. So
Mhm.
yeah, I just wanted to mention that was an eye opener for me. So
Mhm.
thanks for sharing that.
Yeah, when we had the condo boom, the numbers made sense because you could build something at the rates that I showed you, maybe $400 or $500 a square foot, but then you were selling those condos for like $1,000 a square foot. So you're recouping that cost. Now that with interest rates where they are and nobody really wanting to buy pre-construction condos, that's pretty much killed that model. And it means for rentals, the parking just doesn't work because you can't like you're capped at how much you can actually charge for rent, including renting out parking spaces.
Yeah, no, that's a great point. I mean, in Toronto, obviously you can still see parking spots selling for 100,000 each, right? And that's where you can recoup the cost. But yeah, with rental, especially buy and hold, you gotta look at that. But yeah, interesting. Thanks again for sharing.
Yeah, my pleasure. Anyone else got any questions or comments? Yeah, Sahaj.
Just wondering, what's as of right zoning? I've heard of it before, but haven't had time to really look into what it is, just out of curiosity.
Yeah, so the zoning bylaw are the rules that apply to your site, and as of right means that the design that you're proposing for your new building fits perfectly within those rules. So for example, if I'm in a neighborhood that only allows for single family homes, but I want to put in a large apartment building, then I'd have to do a zoning bylaw amendment to allow for that. Whereas if I only wanted to build a single family home in a neighborhood of single family homes, I don't need to do that. Like it's as of right.
Got it. Okay. Okay. Thanks.
My pleasure. Any other questions? Any other thoughts or comments?
Yeah, Sri here from Ottawa. I was
Hey,
just
Sri.
wondering, in Ottawa, is there any time soon that they're going to allow coach house or lane houses in? changes in bylaw coming? Because I know there was a talk of it, but never got around it.
Yeah, so what they've allowed is up to 4 units. They do allow, so that is coming in the new zoning bylaw, allowing for coach houses on these single family lots. The one challenge with coach houses, you need to have a nice large lot to do it. So we've been working with some clients who have been trying to figure out a model of bringing coach houses into the picture in bulk. And it's still a work in progress. Most sites, are highly unique, so it's kind of hard to do a drag like a copy paste drag and drop solution. But they are coming. There are companies out there like Boxable, where you can, pre-order a coach house and then you just do a little bit of site work and then you can drop it in the backyard. What we found is the challenge has more been around the financing and then the appraisals, because it's kind of hard for someone to evaluate what the actual value of that coach house is to the house itself or to the property itself.
Right, because I was in one of those home and garden shows, and I
Mhm.
seen a nice one. They were, I guess, a little over $100,000. They were showcasing this product, and I do have a handful of. I mean, I'm an investor as a realtor. I do have a handful of,
Mhm.
I would say, houses with a big yard on them, like especially in the corner lots and whatnot. So I wasn't. So do you know right now they have any specification of what can fit in there or nothing?
Yeah,
Because
yeah. So there is a section in the bylaw pertaining specifically to coach houses, and the rules around it. We're actually designing one in the Ottawa area right now, basically taking our client's existing shed and adding on to it and turning it into a big coach house. I believe you need to be 4 meters off the property line if you've got windows and main doors, or you can get up to 1 meter from the property line if you're just doing a blank wall. And then you're capped at 1 story below a certain height. I can't remember exactly what that height was. But yeah, it's in the zoning bylaw and it's in the new zoning bylaw that's set to come out next year as well.
And then you said you are doing it. So if I were to approach you guys, you might able to give us the estimate or whatnot, right?
Yeah, absolutely. Yeah,
Okay, perfect. Thank you. Thanks for the input.
my pleasure. Bhavin,
Yeah. Hi, Samuel. How are you?
I'm good, thanks. Nice to see you.
Thank you. Great presentations. I have a quick questions about factory, like the modular
Mhm.
constructions and traditional construction. What's the cost difference between, like, the ballpark number between both,
So
like
material costs are going to be about the same. And
Mhm.
it does depend on, where you're sourcing the material from. Oftentimes they will have deals that they'll negotiate with the supplier to get things below market. But generally, we found the material costs are the same, whichever way you go. Even the labor costs, because you're still paying for their machinery. There's an added design scope to it, so you have to bring these manufacturers on early in the design stages so you can optimize your dimensions up to fit their machinery, and then they have to plan it and basically rebuild the entire model so that they can then feed that into their systems and start creating the panels. So there's added administration and coordination, but the real savings are the time to build and the elimination of like weather delays or site delays.
So that like what I heard, you can correct me if I'm wrong. Um, like the factory or modular, they are actually 10% higher than traditional.
The
Or
materials are more or less the same.
yeah, materials.
Yeah, you're not saving a whole bunch on the materials. There's an added administration cost to plan out the project. So if you were to look at it on that basis and put them up side by side versus like traditional versus modular, it would come pretty close. But you have to look at it as a project, like the whole project, as a logistical planning thing, because you can when where traditional might take, a month or 2 months to frame a house, this can do it in a couple weeks. So you're talking about reduced carrying costs. You're talking about, the reduction in the labor costs. You are able to, plan out your other trades and build in some more cushion if they're between them. So it's more of a logistical benefit that way. And as you scale up and go bigger, the returns expand as well, right? Yeah, so the triplex that I showed you, we kind of were testing out this modular construction to see, what the benefits were. And that project is a bit small for it. We didn't see any huge benefits to our bottom line on that project, but we could see the changes to the logistical operations that would become even more beneficial. So I showed you that stacked townhouse development. That one's where we're really anticipating to see a lot of savings because we've got 4 blocks of 12 units each. All of them can be done using the modular framing, and it can all be done in quick succession. So once we got the foundations in, the framing, click, 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 and they just go around to each of the blocks and get that set up. We can enclose it in a fraction of the time that it would take a conventional framing crew to do it. And then we can start bringing in, our plumbers, electricians, our HVAC guys a lot faster. And on a project like that, where we can cut down the build time by, 25 to 40%, that's a huge amount that we're saving in carrying costs.
Yeah. And is there something, so time wise, and yeah, I got it. Is there something in a financing side, do you see difference, or it's okay the same?
As in, does the fact of going modular have an effect on your financing terms?
Yeah, because sometimes what I come across, because they required different financing, like for example, not only framing, but if you have a modular with the drywall and everything, then they uh, required, I guess there's some kind of, they required a lot of upfront, or it's some kind of.
Yeah, okay, yeah. So the modular guys, they do take a higher deposit. I think that's what you're getting at.
Yeah,
So
I'm
yeah.
referring to that. So how?
Yeah, they'll often require like a 50% deposit, which can be tricky from a financing standpoint if your lender's only releasing things through draws. So we have to factor that in when we run our pro forma analysis and start making our budgets. We do carry a higher amount of equity at the start to be able to pay for those deposits. Um, and yeah, so it's more of a cash flow question than it is a financing question. You're going to recoup that as because you can then once the framing's done, then your lender is going to approve the work that was performed. So you can have a higher draw request at that stage, and you'll get that money back. But it does mean you'll have to carry a bit more yourself up front.
Yeah.
The other call it a challenge, but because it's such a new technology, and the framing system I showed you, this doesn't really apply, but there are companies that do the whole wall assembly, including your your sheath, your insulation, your vapor barrier, your exterior finish and cladding, and then that goes together. So from an inspection standpoint, the manufacturers really have to be the ones bringing in the building inspectors into their shops to review it, and then they have to be stamping it so that you can get your approvals from the city or the building department. So it's just a little different kind of coordination involved during construction. So if you're going with a company that does the full wall assembly, just make sure you ask them, like, how do we get this approved early on, so I don't run into issues with the building department.
Okay. Yeah, no, that's exactly what I was asking. Yeah. Thank you.
All right. Does this zoning change allow up to 4 units in R1 apply to our R1 zone properties as well? Thank you. AK. I'm not familiar. What municipality are you looking at? What area?
Hi there. Sorry, I just unmuted myself. In Ottawa, actually.
Ottawa. Okay. RR1. I'm not.
I think it's rural residential.
Rural residential. Yeah, it should apply there. It should apply
Okay.
in any residentially zoned lot.
Because I was specifically looking at somewhere near Manotick.
Okay, yeah, that makes sense.
Okay. Thank you.
Mhm. Awesome. All right, it sounds like I think that's it for the questions. I just want to share one last thing with you guys. So we are running a webinar on our 48 stack townhouse development project in 2 weeks, same time, Tuesday, October 22nd at 8 p.m. If you're interested in some of the projects that we're working on, including this one, I encourage you to come on out and check us out. I'll be going through this one in a lot more detail, specifically how we put it together, what our expected returns are, and what our business plan is for the site. Keep an eye out on social media. I'll be sending the recording of this webinar, and I'll also be including details on this upcoming webinar for you. So looking forward to doing that one, and I hope to see you all there. And with that, I'll bid you good night. Thank you for listening. Yeah, and have a great rest of your day.
Thank
Thank you,
you.
Samuel.
Take care.
Thanks, Sam. Have a good night.
You too. Take care.